Hello, everyone. Late last week and over the weekend, the major storyline that started unfolding was the failure of the 16th largest bank in the country, Silicon Valley Bank. I'm Andy Pratt, Director of Investment Strategy here at the company, and I'm joined today by Lowell Pratt, President of Bernie Company. And we've been getting some client questions on exactly what happened and what to make of this. So, Lowell, this isn't the first bank run that you've seen in your career. So I just want to start with you. What happened?
Uh, Essentially, there was a what I'll dub a high-risk bank, very concentrated business model bank um, that basically had a fundamental issue with its base customers, the startups and the venture capitals. As they lost access to capital, they started to pull money from uh, their bank, SVB. And ultimately, when they had to tap into their hold to maturity assets, it created basically an old-fashioned run on the bank. And last week, in addition to SVB, there were two other crypto-related banks that also failed. And it's essentially some very weak players, some poorly run banks that sort of all collapsed, sort of as a result of what's happened with the Fed rate tightening. At the end of it all, there's regional banks that came under pressure, and that's what created really the bigger concerns, because the banks specifically that failed were not systemically meaningful banks.
Yeah. So this was a big bank. It wasn't one of the biggest banks in the country, but certainly a big bank. And I think there was a time period there where people were unsure if their money was going to be backed up. And so the government came in over the weekend. What was the government's response to this?
Yeah, so the big problem with SVB is the majority of their deposits were above the FDIC threshold of 250,000. Obviously, the balances up to 250 were going to be covered. The Fed, when they couldn't find a buying bank, which is their preferred response, basically created a shadow bank. And the plan was Monday morning it was going to open and all of the depositors would have access to the $250,000 threshold. But most of the companies in particular that were the bank customers, that was not going to come close to being adequate to supply their funding needs. And so, this is going to be not politically popular across all fronts, but essentially they decided to make all the depositors completely whole. So they beyond the 250 limit, but they are making the bank investors pay the price. Of all of the bank investors, the stockholders, the bondholders, they've all gone bust. But the depositors, which maybe you could call the innocents of the group, they were going to be made whole. The concern about this having a contagious effect across the whole banking system also prompted the Fed to extend a credit facility to the whole banking system for up to a year. And the idea with that is to keep other banks from having to tap into their hold for maturity or long-term investments as well. And as I think we can see in the markets, in the stock market's response this morning, that's basically what the Fed needed to do to keep this from potentially turning into a more serious problem.
So let's say that me, as a client, an investor, someone who doesn't have money at Silicon Valley Bank or isn't overly invested in regional banks in general, what does that mean for me?
Right. So if the banking system had created, sort of a systemic issue, it would mean a lot to you. Fortunately, that does not look like that's going to be likely with the Fed's response to this. So as an investor, if you own regional banks, this is a rough time for not just the ones that failed, but the cousin banks as well. But in a diversified portfolio, which is of course what we run for clients, this is pretty much rub of the green. There's going to be something like this constantly, periodically happening, and you're protected both by the diversity in the portfolio and also by the nature of the types of stocks that we own, which are not the risky stocks like SVB. So the other big effect that this has had is the whole yield curve has shifted pretty significantly downward. There's a concern that the whole banking system is going to kind of go into a bit of a hoarding mentality where they're not going to make funds as available. This is going to have a positive effect on the fight against inflation, and is very likely going to cause the Fed to pause its rate hikes just to wait and see what the economic effect is of the banks instantly becoming more conservative with their policy. And the big thing, like anything else, is you make an assessment, which we've made today, in terms of at the end of the day, basically business as usual. But we're going to continue to monitor this, and if conditions change, then we'll reassess our conclusions.
Yeah. It's always the risks that you don't see coming are always the biggest storyline. So that's the reason we're covering this one in a little bit more detail than we typically would. But certainly, if it warrants, as Lowell mentioned, we'll be in contact with additional communications. And as Bernie clients, you can always reach out to your advisor if you want to talk through it with them. So thanks everyone for watching this video today, and reach out if you do need anything.